What's up everybody, Tom here with another video. In today's video we'll be discussing the biggest stock market news for the week ahead, along with our technical analysis thoughts on the S&P 500, Nasdaq and Volatility Index. Last week we saw some increased volatility in the market, which led to some pretty aggressive selling through Thursday into Friday, and it's time for us to try to make sense of the madness together. Stay tuned. So I think the best place to start is to discuss some of the things that I think led to this current crisis, and I think some of the things that we can always watch and learn from in the future. So one of the things that just happened last week is we saw a high volatility index, or VIX, and that was actually rising while the stock market was rising. Now there's several key reasons in some of the previous videos that we've discussed why this is happening, but generally VIX is really related to volatility in the options over a 30-day period. And what we saw last week was we saw call options getting aggressively bought by retail traders and other traders around the world, and really that pushed the markets to all-time highs. It didn't just push them to all-time highs, it pushed them to extreme all-time highs. And what does Wall Street like to do? It preys on this type of movement, and it preys on obviously the retail herd. If we look at things like the heat map that we always like to do together here to try to make sense of what's happening, we understand straight away that a lot of the declines on Friday anyway were obviously still in Microsoft, Google, Facebook, Amazon, and actually Apple was down for a lot of the day. It went to around 110 and then was aggressively bought into the end of the day, kind of signaling that potentially Wall Street was sitting there waiting to put volume in. When did we see the volume hit the market? When did we see these pickups happen? We saw them into the close. So that means that some big traders were definitely buying into the dip on the Friday. And that has me concerned about whether we are going to see further dips in the market. We actually hit key levels and then almost bought very aggressively off those. So here we have the last week of results. It's still clear that FANG stocks, as in Microsoft, Apple, Google, Facebook, and Amazon, were wearing the brunt, while banks did okay, and we also saw beverages, consumer defensives, utilities, some of the unloved sectors of the last couple of weeks and months becoming slight positive, and we saw a bit of consolidation and movement into those sectors. But to understand what's going to happen in the weeks ahead, we need to look at how the VIX works first, or the Volatility Index. So we've mentioned on this channel quite a few times that the Volatility Index needs to stay above 20 if we're going to see increased volatility. Why is this? Well, 20 is kind of that barrier where if you go over a weekly or a monthly chart on the VIX, you'll notice that it generally, during normal periods of time, will stay below this zone. And it's quite well known in Wall Street that when it goes over 20, we usually are seeing that increased period of volatility, and we're seeing the fear re-enter the market. So we saw it spike again, and we actually had a bullish hammer here on the monthly in terms of the VIX rejection last month. But in terms of what happened on the daily, it's probably best to look at. If we look over here during the flash crash in June, we see that the VIX spiked up heavily, then spiked to a new high, declined, spiked again, and then declined. It did not make a new high after the last spike. So one of the things I'd be looking for this week would be, can the VIX not only get back up to these key levels, but can it make a new high? It did not do so last time. So we'd be looking at a 38 kind of level plus. If that happened on the VIX, that would mean really further increased huge selling and probably the next support being hit. And we're talking about those next supports on the S&P 500 and Nasdaq later on in this video. So really the VIX for me is showing us a similar pattern to what we saw during that flash crash and dip buying, but at the same time, we haven't seen the test of the high yet. If we break that high, which we were unable to do, it will be a very aggressive signal for the markets. Another thing we always look at is we like to look at the biggest stocks in the market, and we like to look at ones particularly traded by sentiment right now. Now, one of those is Apple. Apple is incredible sentiment share. It has a huge amount of retail traders in it, like you or myself. And on top of that, we're seeing some incredible movements away from some of the large moving averages. Now, we've talked it to death on this channel that we're really far away from that weekly 20, and we know that the market will eventually want to pull back into that zone. We saw the market go as high as 137 on the split of Apple, and then of course it went down to 110, 111 kind of area during the Friday initial selling off period, bought very heavily into the day back up to a 120 close. When we go down to a daily, I think things will make a lot more sense. We actually saw a bullish hammer close, or a pin bar, as some people would call it, showing that there is a lot of buying pressure. And my target really was around this 110 area for kind of the first dip buying. We hadn't seen a 50 touch on the daily for a very long period, but when we look through the Nasdaq results a little bit later in this video, you'll see that it really times up with a very similar kind of dip buying experience that we were actually talking about during the live stream we did on the non-farm payrolls on Friday. So 120 has been reached. We see the bullish hammer. Does that mean that we're interested in buying Apple at these prices? Well, we're kind of in what we call a blow-off phase. And the first thing is, whenever you see a bullish hammer like this, it doesn't mean that you want to just jump in and buy in and pick it up. I've always said on this channel that we want to wait for confirmation. We want to see a new high being reached. And when that new high being reached, it shows further momentum in the direction of the trend. And that's important because it shows a commitment of the buyers versus the sellers. We see the commitment to further on. Now, obviously, if we cracked a new low and we got through this 110, that would open up $100 for Apple. And I think this would bring a lot of negative sentiment in, of course, to the Nasdaq as well, which is why we're covering it so much today. To understand something like a blow-off event though, Tesla is probably the #1 share. Not only is it traded by a huge amount of retail traders, it shows, in my opinion, a huge amount of the sentiment currently in the market, whether the sentiment is bullish or bearish, with moves being very aggressive to either side. Now, on a weekly close of Tesla after the split, we can see that it got up to $500 last week, and then of course it went as low as $372. We're still very far away from the 20 moving average on the weekly, but more importantly, we've seen aggressive buying at the end of the day, and again we go into the daily and we'll notice that it bullishly moved near the end of the close. So we saw again it hugging this 20, which it's done so all the way along this bullish trend. The 20 has been hugged very aggressively on this bullish move up. So Tesla's really been holding this 20, and of course a break this week underneath that would really signify back down into these previous bodies, this 330 kind of area, 338 for Tesla. The 50 EMA would also be reached on the daily at the same time. Now, are we going to see that? Well, Tesla likes to move in these kind of aggressive fashions. When it makes a new high, it does so in style. It moves up incredibly aggressively and gets all the way to usually key figures, key psychological zones. Now that we've seen it kind of declining, the 20 is the hold level. If it holds 400, great. That means that if you're in it long, it's going to be very aggressive and very good. If it gets under the 400 though, we see it probably push down to this 350, 330 zone, and it really signifies that we're in a bit of a blow off. So do we expect the market kind of go down like this and then all the way up here? Probably not that fast. What it will do is something like this. It might go down, bullish up to like a 61.8, 76.8 fib in a blow off kind of phase, like it did over here on the left-hand side, and then sell back down and test those lows again. That's generally what Wall Street likes to do. It's like the double dip kind of taking from the retail crowd. So that could be what we see in Tesla in the next couple of weeks. So I think a lot of uncertainty will also be in the markets when we consider things like what happened after a pretty good non-farm employment change. Pretty good figure. Wall Street obviously now wants to see more action by either the Fed or by, of course, Congress. If we scroll down through next week, there's not too much incredible news coming out. But of course, there is some massive news coming out the week after that. And we do expect this to be an absolute firecracker, as in Thursday, September 17th. We have the FOMC economic projection statement, funds rate, all of that good stuff coming out on a pretty giant big red day of news across the world. So put this in your calendars. Thursday, September 17th must be watched, and it must be watched very carefully. All right, let's take a look at the markets now. So we've looked at Apple, we've looked at Tesla. We understand that they're both hugging those 20 exponential moving averages. So what about the Nasdaq? The Nasdaq's really our reader right now, again, of sentiment when it comes to indices. So the Nasdaq obviously went up to about 12,000, almost 500, and it's been liking 500 blocks right now. Then it sold off that zone, gotten under 12,000, and it's still quite far away from that 20 moving average on the weekly. Remember, when we do this analysis, we can see here that it likes to go down to that zone. Now, with top-down analysis, the best thing that we can do is, have we seen this type of event occur before? Well, if we go through, the Nasdaq moves aggressively each way. It's a growth style indice. It's one of those ones where we see a lot of high PEs, a lot of high valuations, and if there's a chink in the armor, they fall very aggressively, and when things look good, they go up very aggressively. So it's not crazy to think that the Nasdaq moved the way it did. When we go down to something like a daily, I think this is pretty much the key chart here. We've been holding this particular 20 the entire way up. You can see this 20 has been the buy zone the entire way up. Very rarely have we breached it, and we've quickly bounced back into that zone. Now on Friday, we breached it and we kind of almost bounced back up, but we actually closed slightly below it, similar to how we did over here. So this is the last fortress really before that 11,000. Now we almost reached that during live trading early on the Friday trade during actually our live stream. We got down to about 11,153 very, very quickly. So this level was reached. We obviously see it rebound here, but I wouldn't be surprised to see it retest this zone. Now, this week will be the one in terms of when we see that Tuesday open. We've got obviously a bank holiday, but notice when we go down to the smaller time frames, it kind of respected this role reversal zone. So what we saw was the 11,000 kind of 500 level, 600 level acting as support. It then bounced back up and then rejected off that zone with a 4-hour 2050 cross coming into the close. These are all bearish signals in terms of technical analysis. So I think the clear dip buying experience here during a weak month, which is September, is pretty much going to be, there's the 50 EMA, and then the next one that you're looking at is probably a fib of the whole move. So you take a Fibonacci of the whole move. We do expect at some point that you usually get a Fibonacci of an aggressive run. I think it's fair to draw a Fibonacci of the whole move, consider the vertical nature. And for us to have a pullback, the 23.6, obviously where it just about reached that 11,100, that's how I got that zone, previous resistances, 50 EMA, and the Fibonacci. Now that's the first buying experience that I would expect. We break that level, the 38.2 becomes open. Now what is that? Just above the 10,000 psychological. So I like the structure around both these zones. I like both of these zones very much on the Nasdaq for the bullish kind of buy dips. And these are the kind of areas that you're looking for as a technical analyst if you believe in the bullish side of the market. Remember, the market coming down to both of these zones doesn't mean bearish market. It just means a normal reversion that you see just on a much grander scale because of the aggressive move of the market. So I would not be surprised to see Wall Street push it down to these levels. So let's take a look at this S&P 500, but firstly, I just want to mention these central pivots and monthly pivots in general. So we had the monthly R1 being reached on the SPX, the real market here, and the monthly R1 sat around 35.81. We then saw the monthly S1 get tested at 33.50, and both these zones have held currently the market. It just shows you that it's worthwhile doing your analysis on the S&P 500, the real market, and using those monthly pivots. They can help you for take profit zones and for potential dip or buying zones in general. Now, we certainly expected the market to get down to the central pivot during this particular drop off in the market, and it did so, but we did expect probably further buying pressure here, at least initially. The surprise really was that it sold off so aggressively after the non-farm payrolls result, which was relatively okay, and then it further sold off down to kind of the second buying zone. I was hoping on making a video around this second buying zone before it really occurred. But all is not lost if you're looking at the buying experience down here. I think that if we do see further selling this week, we get through this 20 exponential and we close below it on the daily, that will be a very bearish sign back to the 50 EMA, back to where previous dip buying experiences have been had, which is here and here. And of course, potentially even down to the 3,300 zone. I'm really drawing the 3,300 and the 3,200 just before those zones will be the main key supports. And I think here it's worthwhile drawing your Fibonacci potentially between the last dip, which was really back in June, and where we are now. Why is that? Well, I think this was a decent dip, and I think Wall Street will be drawing some of these lines. Now we've got a 61.8 fib back at that 32, and of course we've got the 50 fib sitting just around that 32.80-ish zone. Now we hit the 38.2 of it. We expect that to be buying pressure, especially when it was also reaching the monthly S1. It does make sense that was a heavy buy zone, but if we do see further downward pressure this week, that would be very significant to the market. Again, like any kind of pin bar rejection or anything that happens with these kind of rejection candles, we don't necessarily want to be jumping the gun with buys for trades on Monday in the futures or Tuesday. We want to wait for the market to reach a new high, crack this zone, and show positive momentum in the direction. We'd also prefer it to get above 3,500. That's more of a trading idea. From dip buying though, we're looking at the 3,300 and 3,200 zones at this stage. And that's purely based on the 3,300 having kind of the 50 EMA around it and some previous structure over here on the left. And of course the 3,200 having serious structure on the weekly as well. So I guess to summarize this video, we are seeing some pretty aggressive fall offs. We do expect it to potentially still be wild ahead of the FOMC meeting. Remember that date, you should be putting that in your calendar, which is the 17th of September, at least my time. You should put it in forexfactory.com or some other economic calendar, and it will come up with your specific time frame and zone. But it is September, and September is a weak month. Remember that this was more of a flash crash from Wall Street to take money off probably the buy calls, to close those buy calls, and of course put pressure on the market that way. Here we have another just current reason of why the markets, while they seem ridiculous right now, at the same time may not be. Department stores, some of the companies that are going under huge pressure in the markets, make up a very small percentage of the market overall. Remember, it really is right now about the tech. It's about the big six. The big six still make up 26 to 27% of the market. Amazon, Microsoft, Facebook, Google, and Tesla with Apple together now make up half of the Nasdaq 100. So it's incredible how large these companies really have got. If you've enjoyed this video, please make sure to subscribe and of course hit that alert button. And I just want to quickly remind everybody, we're approaching 20,000 thanks to the support of you, the trading and investing community. We'll be giving away $500 just for being a subscriber and potentially following us on one of the socials down below. And we do appreciate each and every one of you. Good luck this week, everybody, and we'll see you in the next video. Bye for now.